Hey, welcome everybody. It's Chris Miles here. So excited to have you here. I know many of you are starting to jump on right now or starting to get added to the room. So I want to make sure we have that there. Um, just as you're coming in, I just want to show you my shirt today that I've shared several times on podcasts I've been on because this is the definition of financial advisor, which I'll talk about today, which is this. Oops, wait, let's get the mic out of the way. There we go. A person paid to sell you crap, not make you more money. so that is what a financial advisor has done. And we're going to talk about how to get away from that today, especially as we talk about how to double dip on the returns of your money, especially where tomorrow we talk more about passive income. We're going to talk about how you can actually get that income to pay you twice. That's the focus of today's presentation here today. So thank you for joining us and being a part of that as well. If you're on here, just go ahead and say hi. Go ahead and type in the chat, say hi, where you from, that kind of thing, especially because when I'm on StreamYard here, I just see Facebook users. So I don't know who you are, but yeah, please go ahead and say hi, type that in the chat comments here, and love to know who's joining us right now. All right. So as we're doing that, as those comments start coming in, because I know it takes me a minute to even see them after you guys post it. So I'm kind of like the late guy whenever I see it. Um, here's the cool thing I want to talk about today is I want you to be able to get your money to work for you. Now, whether you're ready to invest or not, this is a strategy that can be employed whether you've got a few $100s a month or 5,000 a year, or you got 500,000 or $5 million a year. This is a strategy that can work, but it's not one that many people know about. Okay. Oh, thanks for saying hi. Appreciate you coming in there. Um, Not many people know about the strategy. Now, this has been taught. I mean, if you go on YouTube, you can go down a whole rabbit hole. But I'll tell you, the strategy that we talk about is more referred to as max ROI infinite banking, which is different than most every other type of infinite banking out there. If you ever go down that little rabbit hole, the problem is it's just not the same. Uh, as many of you know, I was a financial advisor at one point in my past life. I've since repented. I've born again, basically threw away the financial advisor suit and everything else, which is why I wear t-shirts and even shorts. Yes, I even wear shorts here. You're welcome. And so, I used to do that back in the former life. Now, as a financial advisor, I never even heard of that term infinite banking before. But as I started to explore into this alternative investment space of like real estate investing, things like that, all these guys kept talking about infinite banking, infinite banking. I thought, what the heck are you talking about? Well, when I realized they were talking about life insurance, I'm like, are you kidding me? And then when they said it was whole life insurance, I said, hold on, I was a financial advisor. I taught people that whole life sucks. You should never do that. Mutual funds are way better. You make nothing in whole life. However, when I started to question where did I get that information from, I got it from other financial advisors. And even then, they still didn't. It wasn't like we actually had anything like that because we were so anti whole life that I never actually had any numbers to prove or back it up. And here's the other thing is that, yes, from an accumulation standpoint, I'll say this strategy, if you just use it for retirement, it's good, but it'll never make you financially free. Never, ever, ever. Like none of the things that any financial advisor or insurance agent can offer you will make you financially free. I'll just say that out right now. Nothing will make you financially free. But if you use the strategy the right way to work for you now, not for waiting for retirement, then you'll start to find out that this thing is actually it's just awesome. Okay. So I'm going to start sharing my screen here as we get rocking and rolling right now. I'm going to make sure we get that going. So again, welcome those of you that just joined in here and you've been joining in and logging in right now. All right, here we go. So how to get your investment money pay you twice, right? For those of you who don't know me, I didn't really give much of an introduction on myself yesterday. I do live in Utah most of the year, although we do snowbird in the wintertime because my wife is Venezuelan. She's like, I hate Utah winters. I hate the cold. We got to go somewhere warmer. So that's what we've been doing. We have 8 kids together. I've got 6. She's got 2. Therefore, you could tell that obviously she has been popping the stress pills ever since. No, I'm just kidding. But she's definitely had to make a much more major adjustment than I did. This is actually a family from almost 6 years ago, and now 2 of those boys are about as tall as I am, if not almost taller, and as well as one of the girls. So we've got a growing family. Oldest is 18, youngest is 6 right now. I've been financially independent twice, and of course, our focus is the very few things we're talking about here, which is infinite banking and of course cash flow consulting, right? All right, so double arbitrage. Let's talk about what arbitrage is. This is a concept that I didn't understand even after being a financial advisor. Arbitrage is simply this: when you take money and you go make a higher return than what it's costing you for that money, it's called arbitrage. When a bank borrows your money as debt, when they borrow it from you out of your savings account, paying you point nothing percent, but then they turn around and loan it to everybody else at 3, 4, 5, or even 18% for credit cards and the like. Well, guess what? They're creating arbitrage because they still do pay interest to you, don't they? You never see the banks ever follow Dave Ramsey's advice, and banks have a lot more money too. You never see the banks say, call you up, say, hey, I love the fact you've had money in our savings account for so many years, but we were just listening to the Dave Ramsey show recently. And you know what? After listening to the show, we realized we're paying you way too much interest at 0.1% or 0.05% or 0.01%. I mean, do you know how much that interest ends up being over our lifetime? It's horrible. So we're going to pay off all of our debt. So we're paying everybody back their savings account. Just take your money, keep it. We don't want it. Have you guys ever heard a bank say that? Like, never, right? It never happens. No, not once do you ever hear a bank saying, take your money back, please. In fact, if anything, they want to keep it away from you. That's why they incentivize you with higher interest rates by keeping it in a CD. If you keep it there longer so they can do more with it, they pay you a higher interest because they don't want you touching that money. They want you to keep it with them so then they can go and leverage more than what you give them. Interesting fact, banks can loan, for the most part, 10 times whatever they have in assets. So they've got $10 million sitting in cash. They can loan out $100 million, making massive interest on it. They are literally making bank off of you, right? Pun intended. Yes, I did make a crappy daddy joke pun right there. But it's true. They make bank off of us. What if we could turn that back around? What if we could be the ones creating arbitrage by us paying less interest for the use of money where we get paid more in interest? And I'll talk about what that means. Just so you know, most of the guys like the Dave Ramseys of the world, even if they get asked about it all the time, they really don't get it. They don't understand it. Most people just don't. They don't understand how this truly works, and they don't care to. They don't really want to get involved in that. And that's their loss. That's fine. Just so you know, I guarantee Dave Ramsey has these policies. Guaranteed, because I can assure you that with him having $100 million business, I'm sure there's been several attorneys saying, Dave, you need to make sure you can pay taxes because you're considered rich now, thanks to selling everybody your crap. So you need to get whole life insurance. So the very thing that he rips on, guess what? He's got it. The other thing he also rips on is that, he talks about real estate, how he went bankrupt. He has tons of it. So many of the things he talks about not doing is what he does do. So just so you know. But banks have been using this very particular strategy I'm about to teach you for many, many, many years. They're still using it today. Even during the last recession, they were stuffing money in these places so that they had actual certainty of money and they can go and create more arbitrage, make more money off of it. All right. So what we do is we use high cash value whole life insurance. This is very different than what I was introduced to about 16 years ago. When I was introduced to it, like I mentioned in my story that there was all these guys that were real estate investors saying, "This is awesome. You should do this infinite banking thing. Be your own banker, Nelson Nash." Well, I eventually met a guy that did those kind of policies. He set those kind of policies up. Now, I quit being a financial advisor at this point. I was just a sponge. I wanted to learn. He taught me it. I got the vision. I was like, this is pretty cool. I like it. Now, here's the thing is that if you get a traditional whole life policy, which I'm not talking about doing here, but if you get a traditional whole life policy, they are expensive. You pay for the first 2 years, all the money you're paying into these plans go to insurance costs, at least if you do it the traditional way. So when he was showing me the numbers, he said, yeah, Chris, first 2 years, it all goes to paying those insurance premiums. But then after that, it starts building up cash fast. So better than term, because term, you pay your whole life and you have to die to get money, which means you get nothing. But here, you pay for the first few years, all the money goes to insurance costs. But then after that, then very little goes to insurance costs. Most of it's just going to build up in this tax-free savings account that pays you much better than the bank. And I said, okay, great. That makes sense. And he's like, yeah. And look, you can borrow from it. You can buy cars with it or buy houses and pay yourself back versus paying the bank. He would say things like that. And I thought, oh, this sounds great. So I got it. Flash forward, the recession hits. I had that policy for 2 years, going into my third year, and I paid $25,000 into it, but I had no cash. But I also couldn't pay the next year's premium because I was cash tight. I was going in the hole. Like you heard yesterday, I was over $1 million in debt. So when you're in the hole 15,000 a month, you're not going to want to pay another 12,000 a year to something like that. And so I was like, I can't pay it. What do I do? I called the insurance company. Hey, what can I do here? They said, well, you don't have any cash savings in this account. So if you don't pay the premium, you're going to lose it all. And so I did, lost everything. I paid 25,000 to only lose it. Now I blame myself. I was like, listen, it's my fault, obviously, that I was in that cash crunch. But I had asked this guy, I said, is there a way to make this juicier? Right? Is there a way to make this where there's more cash up front? He told me no. What did I find out months later? He lied, absolutely lied about that. So I started debating with him. I actually sat him down. We had a 2-hour debate about what's better. I found a way to do this where you can actually have cash from day one, not paying it all into insurance costs where you just it ends up being the most crappiest, expensive term policy possible. No, day one, you have cash in there. So we went back and forth, and he told me why you shouldn't do that way, this and that. We have people on YouTube that have done the same thing. Oh, you don't understand it. It doesn't work that way. It's better to do it the other way where we make more money. Bull crap. You guys just make more money off of this. Okay. If I can be blunt, sorry guys, I'm going to be blunt about this. It's true. You make more money. It's bull. Well, I showed it to him. And after I knocked down all of his objectives over those 2 hours, he said, Chris, I can't afford to cut my commissions to do that. And there was the truth. There it was. For him, he knew he could do it, but he didn't because he knew that he would be paid less in commissions. Why? Because insurance agents make money off the insurance costs. The more you pay in insurance costs, the more money they make. When they're in the rat race themselves, when their whole income is coming from this, when they're in a scarcity mindset, they don't realize they're like, well, I can't cut this back. Even if they could, even if they know how to do it, they don't because it costs them money. Interesting fact. With one of the insurance companies, I'm one of the top guys in the insurance company where I only worked about 10 hours a week average last year. And I do this very strategy where I get the minimal cost possible, minimal cost to get you the max ROI. And guess what? It worked. So that person, that scarcity mindset is bull. It doesn't work. And that's what we're here to disrupt. And so I'm going to teach you a strategy that, not just about insurance, right? That's not the point of this. I'm actually going to teach you a strategy how this actually works with your investing. Key point here. I've had a few people come back and say, okay, Chris, so it sounds like the way to become financially free is to do this infinite banking. And that answer is no, it's not. You do not become financially free from this. The investments are what you become financially free from. But if you knew you can make an extra couple percent on top of whatever you're making in real estate, why wouldn't you do it? Okay. So here's how it works. We're creating what's called like a supercharged tax-free savings account. Most people just take money, you see the big dollar sign that represents your money. I know it's really complex there. And then they go and invest it. And then that cash flow from the investment goes back into your checking your savings account, right? So imagine this, say you had $50,000, you bought an investment property. That investment property is paying you, say, $5,000 a year or about $420 a month. Well, you're taking that $420 a month and you're putting that back into your checking or your savings account to then build it back up again. So then you can go and take that money and invest it again to buy maybe another property. It might take you years, but you'll do it. This is no different. The main difference is instead of putting your money into a bank where you earn 0.nothing%, instead we're putting this into a tax-free place where you earn 5-6% in this kind of account. Makes way more money. And it actually allows you to make money in two places at the same time. Because here's what we do. Instead, we get the money into your life insurance policy. Again, high cash, so there's minimal costs coming out. You get maximum returns in your policy. The key is how do we lower the cost of the insurance so that this allows it to grow quicker? We do that. And now instead of just cashing the money out, which you can do, you can withdraw money from this policy. We're not going to do that because when you withdraw money from anywhere, whether it's savings or any kind of savings for that matter, and you go and invest it, Well, now you're making money in the investment, but your savings is depleted. You're not making any more interest in that savings account. But what if you could have your cake and eat it too? What if you could still have the money in savings and still invest it? So you're making money on the savings, compounding interest here, and you make money on the investment. That is what you do with this life insurance because now you do this arbitrage. You become like the bank. What you do is you get a line of credit against it. So you get a loan from either the insurance company or specialized banks that do these kind of loans where they use the cash inside the policy as collateral, not the death benefit, but the cash savings, that tax free savings account they use as collateral. So, say you have $50,000 in there, you get a line of credit against it to invest in that real estate property. Now, the cool thing is as long as this works in most markets, the interest you're paying on that loan is less than what they're paying you. So even if you get the loan through the life insurance company, you're still earning money on that full amount. So that 50,000 you used to invest is still there in your account earning tax-free compounding interest while you're also investing. Yes, you've got interest that you're paying on that loan, which is less than what you're earning there. Give you an example. Say that the loan interest was 4% on that 50,000. That means over that year, you would have paid $2,000 in interest. But if that $50,000 earning, say, 5% interest, right? That's only 1% more, but that 5% interest now is paying you 2,500. Guess what? You just made 500 bucks for free. You just made an extra $500 there on top of the $5,000 a year that you're making inside on that real estate deal. So instead of just making 5,000 a year, now you're making $5,500 a year off that same real estate property just because you chose the life insurance instead of just using your savings account. Here's what's also cool. On top of that, like I mentioned, it's tax free, but in most states, it's 100% protected from lawsuits and creditors. Even if somebody wins a lawsuit against you, they can't touch this money. There's almost nowhere you can put your money. Even in IRAs, people sue you, they can get access to your money. Mutual funds and stocks, bonds, savings accounts, they can go and access that money if they win a lawsuit against you. Same thing with creditors. They can get to it. Life insurance, they cannot. Little bonus tip. If you're trying to save up for college, right? If you save in a college 529 college savings plan, that counts against you when you're trying to get financial aid from the school. But if you use the life insurance, because it doesn't count as an asset, at least in that sense, for education purposes, you can have millions in there and still your kids could qualify for financial aid from that university. Pretty cool, huh? Just so you know, you can also use this money as cash reserves. I try to go do a loan, like I get a mortgage for investment property, when they ask me for my savings account, I don't give them my normal savings. I give them the statement from my life insurance. I just say, here it is. And they say, yep, that counts. Check. Cannot do that with a 401k or an IRA. They will not count that as liquid reserves. But if it's checking, savings, money markets, or life insurance, cash value, they'll count it. Great thing is though, like I said, guaranteed growth. Like at least most of these companies are paying at minimum at least 5%, even in bad interest rate environment like we had a few years ago. There's no stupid limits or penalties. So you know how you have Roth IRAs where if you try to take it out before you're 59 and a half, they'll give you a 10% penalty. They'll slap that on you. If you even do some other things wrong, they might even slap some other taxes on you too. There's no 59 and a half rule. You can access this money a month after you set it up, no matter your age. There's also no limits because with a Roth IRA, they only let you put in 6 or 7,000 a year. I have clients putting in over 500,000 a year, even, they can put in as much as they want. And there's no income limitation because if you make too much money, then certain investments like Roth IRAs, they won't let you invest in anyways, which is fine because most of us that have more money realize Roth IRAs are kind of just smokescreen. They're just jokes. They're like the poor person's way to be able to try to create some money. But the truth is a Roth IRA won't get you there either. You can't save $6,000 or $7,000 a year and hope to ever be financially free. It doesn't work that way. So this doesn't have all that issue. You can also get bank leverage. I'll talk about that in a bit of some other cool strategies you can do with this. But the key thing is you have access to cash now that you can actually leverage and get your money to pay you twice. So let me show you a couple examples here. Here's one. Now say that you want to get a big apartment building. So I show in a bigger example here. This works with small stuff, but I want to do a big one as well with some people that are like real estate investors. If you have a small apartment building, you got to put $250,000 down as a down payment on that property. Say that the cash flow on this after you've paid all expenses is $2,500 a month. Now, If you took that 2,500 a month for the next 9 years, that's 270,000 you've eventually built up. If you put that into a savings account, guess how much interest you would have made at 0.1% that you then get taxed on? $1,228 you made over 9 years, putting that $30,000 a year into your savings account. That's so not sexy, isn't it? That's not much. I show like a total 0.45% return over 9 years on that money you earn 0.1% on because you get taxed and everything else. $1,228. Even if you didn't get taxed, it's still like $2,000. It's not much. But what if you use the life insurance instead, doing the same thing, but instead you get that line of credit and you take the cash flow, that 2,500 a month to pay down that line of credit, and then you can pay it down and do that. What happens then? Guess what? I just redid the numbers to be more up to date with interest rates right now. This is based on a real policy. It's not $1,228 a month or $1,228 of total interest over 9 years. It's 126,000, almost 127,000 of interest profit. That's even after paying the interest to the insurance company or the bank for the use of that loan. 126,000. That is 100 times better than using a savings account. Sound too good to be true? Maybe, but I'm telling you, I ran the numbers several times. That's the number I kept coming up with my own policy. Okay. And just so you know, we set up our policies on our clients the same as we set up our own. It's the same exact strategy. So, same thing. If you're younger, that number could actually be higher. If you're younger than me, I'm almost 45. For people that are older, it might be a little bit lower. Either way, it's way better than point nothing percent that you get taxed on. That's my point. Okay. And just think about it this way. I mean, you just use $250,000 to be able to invest and buy real estate. After 9 years, you have now about half that money in addition to it. So you have another 126,000 you can invest again. Imagine how much more money you can create just because you got paid more interest. That allows you to do it faster. And this is why many of our clients that hire us as a consultant that are just doing stuff for passive income will look at this and say, wait a minute, if I do this strategy with the investing, this is a no-brainer. I make more money anyways. This actually speeds up my progress towards getting financially free, to getting out of the rat race. That's the point. That's the whole goal of this. Almost every other person that talks about infinite banking does not do it this way. They're telling you, use this as a retirement account when you're 65, 70 years old. Well, no, I want money now. Cash flow now. That's important. I don't know if I'll be alive at 65 or 70. I hope I am. I'm doing everything possible to be alive to 100. But there are no guarantees in life. We only have control of today. That's the point. Even if you're a business owner, because people say, well, okay, that's great for real estate, but what if I want to invest this in my business? Even better, because in business, you probably get better returns than even I might get on real estate. Say, for example, you're going to invest 25,000 into marketing, and you're like, I'm pretty certain with the marketing we do, we'll make 5,000 a month. Just so you know, most business owners, if you're not one, most business owners want to make their money back within a year. All right. So even 25,000, we want to make at least 2,000 a month. Well, let's just say it's 5,000 a month. So it takes about 5 months to make their money back. The savings account, I did the math. It was like nothing because there was not enough time for you to earn 0.1% in 5 months. Use the life insurance. You just made an extra $1,000 profit in those 5 or 6 months. So pretty cool, right? Pretty awesome. So that's how this works. Again, you take the cash, and instead of just using that to invest, we run it through the life insurance first. Then that money goes out as we take a line of credit against it to go and invest while the money's still all there, earning tax-free compounding returns while protected from lawsuits and creditors. And yes, it could still be a retirement cash flow, but the key thing is we can invest today to make more passive income now, which, by the way, actually helps you pay for the policy too. So you actually, in many cases, over our clients are like, well, actually, with all the investments I'm doing, it's actually paying for the policy. So really, we're just using this to buy more properties, right? So that's how you make money twice. Now, let me give you a few other key things here. I'll open up for questions. Many people ask, okay, what's the difference between this and other infinite banking? Well, on the left-hand side here, if you can see this comparison, I ran into this scenario where this person's a really good infinite banker. They do a good job. They actually know how to maximize it, yet they don't always pull all the right levers. They don't either take the time to do it, or they just think, oh, it's good enough. So it's close, but even from day one, we have about $100 more, of the 10,000 they put in. Even by year 7, they had almost 52,000. We had 60,000 in here at year 7. If you can see that total cash value, we had 60,440 where they had 51,966. And you had to actually put in less because you had about $100 a year cheaper premium than they had. So again, efficiency. How do we make it as cheap as possible to get the better returns? Um, Many people ask us about index universal life. Like, hey, I have an IUL. Does this work? Because IULs got popular. I'll just let you know, as a traditional financial advisor in the early 2000s, I was one of the early adopters of IUL. I loved them in the past. But as I started to train other financial advisors how IULs worked, found out there's a lot of things missing. One, you don't get this double dip effect, right? When you leverage it, they don't allow you to, you really don't make any money on that money that you leverage. So you don't get that extra compounding effect. Two, costs go up every year. I just saw one come through today that our guy Parker, and actually, just so you know, we'll put in the comments here if you guys ever have any questions, you want to see your own situation, we'll put contact information for us to be able to talk with like Parker, for example, to get on his calendar. But anyways, he sent me one from a guy who was a dentist. He had a lot of money he built up over the last 12 years inside of his IUL, but he would have to keep funding it the rest of his life. And even if he did, the crazy thing is, even with their projections at age 100, it would have ran out of money. So he'd have to pay that. He was paying like 55,000 a year for this policy, and he would run out of money at age 100. Where if we did the same thing, we could actually stop paying after 7 years and it would keep growing and growing by more and never run out of money. It's a guarantee to always keep growing. So way big difference. So costs go up in those universal life policies, where ours, the costs go down, and there's just no certainty. A lot of them are tied to stock markets and stuff, and stock markets suck. Okay, let's just be honest. They're not great. They're not as great as they're cracked up to be. The only people that think they're awesome are people that make money from you putting money in those places, not from them making money themselves. Okay. All right, here's the example of an IUL. Even if you thought they could be better because they can make potentially higher returns than the whole life policy, even this example, you can see after 10 years, this person paid 120,000, 12,000 a year, and yet their cash surrender value, the cash they actually have in savings, is about 85,000. In ours, after 10 years, on the right-hand side there, 142,000. So now you've got about $60,000 more almost in what we do versus theirs. So even when it's comparison, it's really not much of a comparison. Who is this not for? Because this is not for everybody. Okay. One, if you're paycheck to paycheck, if you can't even rub two nickels together or you have too much month in the end of your money, go back to yesterday's training about ways to find and free up cash flow, because that's what you need right now. Don't do this strategy if you're paycheck to paycheck. This is more if you've got extra that you're saving up, even if you're putting money in your 401ks. Many of our clients stop funding their 401ks, put it here so they can actually create passive income before the age of 100, right? But at least before the age of 60. So this is one strategy you can do. But if you're paycheck to paycheck, really find ways to free up cash flow. Maybe you buy cheap convertible term insurance so that you could convert it down the road. Then at least you get a good, you get a policy you can use that you don't have to requalify your health for in case anything happens in the meantime. So if you're paycheck to paycheck, you're not going to do this whole life strategy. Also, if you're in bad health, if you've had like cancer recently, if you've had suicide attempts, I hope not. But if you've been hospitalized for things like that, if you've had like if you're a tobacco user, if you're smoking, even vaping, it's going to be pretty expensive, or you might not even be able to get insurance at all. So this may not work. I actually had a guy that was 400 pounds, and he wanted to do this strategy, but he knew that for him being in his 50s at 400 pounds, he's probably not going to get the best rate. His costs are going to be really high. But his wife, however, was in her early 50s. Plus, she's a woman. Women live longer. So as a result, we put the policy on her instead. He was actually putting over $100,000 a year into her policy because she would make a much better return. And they've been leveraging it and using it like crazy. He's been investing in like oil and gas type of investments and stuff like that with it. So great strategy there. But if you're in bad health or you're a tobacco user, it's not going to work as well. Also, if you're over the age of 70, this gets a little bit trickier. It could work if you're in amazing health, but if you're over the age of 70, most likely we're talking more about just having a death benefit, not trying to use this as an investment. But like I just mentioned earlier, you could get this policy on a spouse or on your kids. Many of our clients are actually getting rid of their 529 college savings plans and they're doing this instead, or they're just saving it all under themselves. So there's a lot of different ways to use this, but it's definitely not for those of you that are paycheck to paycheck in really bad health, or you're just, into your 70s and 80s, age wise. Now, ways to use this. I mentioned emergency fund or reserves. For example, in my family, my wife says, I want 250,000 sitting in savings just in case the world blows up, right? Well, not literally blows up because then nothing would matter at that point. But if things go crazy, that's absolutely crazy with war, depressions, whatever. She's like, I want to know that we have a good chunk of money to live on forever, regardless of cash flow and the passive income we're already making. Well, 250,000 sitting in our savings account earning 0.1% at our credit union is not too sexy, is it? I mean, think about it. 250,000 at 0.1% only earns 250 bucks a year. That's like 20 bucks a month. But what we do, and this is why I told her, I said, let's earmark a bunch of money in our life insurance instead. So then we can invest the rest of the cash that's sitting in savings. So 200,000 of our life insurance is now sitting there, not being touched, but now it's earning 5+% tax free. So what happens is that now 200,000, do the math, 5%, that's 5,000, or no, sorry, take that back. That's $10,000 a year versus 250 bucks a year. Much better, right? Now I'm making more interest anyways. If it's going to sit there, at least make something off of it. That's helping combat inflation a little bit. By the way, inflation is actually good for these because the more interest rates go up, the more that the dividends go up as well. So actually, we're in one of the lowest dividend rate environments, and we're only getting 5.75, 6% only, quote unquote, on this. 20 years ago, when the interest rates were higher, these things were actually paying like 9, 10+% before. So emergency fund or reserves, great place to store it. Cash flowing investments. We already mentioned this, like using this to invest in things like real estate. It can even be used for short-term stuff. If someone's like trying to, fix and flip a home, people love this because they don't have to pay interest in the meantime. The interest will charge, it'll be added to the loan, but you don't have to pay for it every month. So nothing's coming out of pocket until you can sell the property. You can choose to pay it off if you want. I had one client where she said, hey, my son and I did a deal. We took a loan out of this a year ago. I made 35,000 of profit. She's like, do I pay off the loan or do I just reinvest the money? And I said, well, do you already know where you're going to invest it? Yeah. I said, well, great. If you want, if you really want to keep this from compounding against you, pay the $6,000 of interest you were charged and then invest the other 150,000. Now you got more to invest the next time. And yeah, you still have the loan out there. So you didn't have to pay off the loan. So she did that. Other people, they're just doing monthly cash flow. If they're getting paid quarterly, like on some of the investments we'll talk about tomorrow, some pay quarterly. Great, you pay quarterly. You could pay, by the way, the loans, you can pay back however, whenever you want. Again, like I said, the deadline is your death. You can also use it as collateral, not just collateral from the life insurance, but even collateral for banks for other purposes. So, for example, I had a client out in Minnesota that he had about 300,000 sitting in his old life insurance policy. And he was like, I want to buy this building for my business and then I'm going to rent out some units here. But I think I'm just going to cash this out. I'm just going to cancel my policy, get all the cash out of it. And I said, hold your horses. Like you could do that. But instead of canceling this policy, let's see if we can go to your local banks and just see if one of them will give you a line, basically give you a loan using that as collateral. Because this cash is certain. Like banks will do this all the time. You can even take your normal savings account. You can go to the bank and say, hey, will you give me a line of credit based on my savings account that I have with you? And they will. It's easy. So they did that with him and they saw it and they said, okay, well, we'll give you what you're asking for. He asked for 375,000, more than he had in the policy because they had to have extra cash to, renovate and build out that building. That payment they got like 2.5% lower than the going rate. So they got a way lower interest rate, amazing monthly payment. They're only paying like 1,800 bucks a month. Well, after a year and a half, after everything was built out, he had renters in there, plus his own business was in there. And the renters, by the way, were actually paying for the payment for him because the payment was so low. And he went to the bank. He said, hey, can I take the lien off of my life insurance? And they said, yeah, you got a building now. We'll let the building be the collateral and we'll just free up that 300,000 for you. So that 300,000 was free to do whatever the heck he wanted again. So it was pretty cool. Some clients have had pay off credit cards with it. They're like, instead of just, paying off credit cards to my cash, maybe I run it through this, pay off this high interest credit cards, and I can just pay myself back however I want, so I can pay down a much lower interest line of credit. Kind of like a HELOC, if you get a home equity line of credit. Retirement income I've mentioned, and of course I mentioned kids savings. Some people even want to turn over the policies to the kids later as a gift. Maybe it's like after college, maybe it's when they're buying their first home, or when they're getting married, saying, "Hey, I have full control of this policy for years. Thanks for letting me use your life for that purpose. Now I'm going to turn this over to you. It's yours to keep now." Others can even do things where you can actually create perpetual wealth for generation after generation, much like the Rockefellers, the Hiltons, people like that, where you actually buy policies on all your family members and it pays into your estate, into your trust. And so whenever somebody does pass away, it just keeps building that estate plus all the investing and things that you do too. You can actually build a very large estate over many generations versus most people when they get inherit money, they blow it. So, yeah, lots of cool things you can do with this. So, anyways, I'm going to open up now for questions at this point because I've talked plenty. So let's hear from you. What are questions that you guys have for me? Actually, I should probably look at the ones right here too. Oh, awesome. Danielle, thank you for putting in the free gift there, access to our team. You can kind of see the training for the infinite banking there. Another thing too, everybody, let's give Danielle a hand. Thanks for, again, making sure that I can actually do this and not, not be able to have the issue of figuring out how to even turn on my computer and things like that. So Danielle, really appreciate you, setting this all up. Had somebody say that, hey, we need to chat soon. Awesome. Yep. Definitely check out that link for sure. And yeah, there's lots of ways you can do it. Other questions, maybe the things that maybe didn't quite make sense when we were talking about this, or things you may want more clarity on. How can I help answer some more questions on that for you? And while I'm waiting for that, just to give you a little closure on that story, that insurance agent that sold me my policy, he's no longer in the business. He's out of business now. My goal with this is actually to put, I don't want to put people out of business. Let's be clear. My goal is to disrupt this enough so that insurance agents say, maybe I need to step up my game and do what's right for the client instead of just what's right for my family and my pocketbook. So that's the big thing there. Wow, we might have actually explained this nicely enough that people are like, I got it. So I'll give you guys a few more seconds to ask a question. Otherwise, I'm going to sign off at this point. But yeah, this strategy is great. Again, never needed for financial freedom, but dang, it's awesome if you can add an extra few percent return every year to the investments you're already doing. It's awesome. It works great. Oh, I would not use this. Here's another reason I would not use this. Do not use this with investing in stock market, Bitcoin, anything that's speculative. I wouldn't do that. You really want to make sure that you do the right things here. So that's the key. All right, guys. Well, appreciate your time here. We put the link in there so you can get more training on this and get access to our team to be able to look at your numbers. Feel free to go and do that. But guys, appreciate your time. And tomorrow we're going to talk about passive income. I know you guys have been waiting for that already. We're going to talk about where can you invest. What are those alternative investments you can do that allows you to be able to get out of the rat race within the next 5 to 10, maybe 15 years, but not 30, 40,000 years from now. So definitely we're going to talk about what are those options? What are those ways you can create passive income right away? So guys, thanks for tuning in and we'll talk to you later.